The summer of strikes extending into the fall here. The latest Kaiser Permanente workers hitting the picket line in several states today. This one is planned to be temporary, but the demands echo what we've heard from UPS workers, writers and actors, and auto workers. A lot of it goes back to higher pay. And while there have been concerns about wage inflation as a result, a new analysis shows that might not be the case. Joining us now, David Miracle, Goldman Sachs chief U.S. economist. David, thank you so much for being here. Really interesting research here, because we here have been discussing a lot what all of this union activity ultimately will yield for U.S. workers. Talk to us about how their wage increases compare to non-unionized workers, for example.
Sure. Look, in 2022, we had a high inflation problem, and at least part of that problem came from wage growth running at a rate that's not compatible with 2% inflation. We got there in part because we had a very tight labor market, and we experienced a number of inflationary shocks that drove up headline inflation, enough that this was not lost on workers. They knew their cost of living was going up sharply, and reasonably enough, they wanted some compensation for that. That translated into a rate of wage growth that we estimate peaked at around 6% year on year. That's a ways above what we think would be compatible with 2% inflation. We think something more like 3.5% is compatible with the Fed's inflation target. The important point, though, is what we're seeing with unions right now, I think, is more the final echo of that inflation and wage surge last year. What's different about union members, it's tempting to think that what's different about them is they have more bargaining power. So they're sort of the vanguard of these demands for bigger wage increases. But actually, I think what's different about them is simpler. It's that many of them, have multi-year contracts. On average, their contracts last about 3 years. So all of those big wage increases that other workers were able to ask for last year, many unionized workers just have not had an opportunity yet to say to their employers, inflation rose a lot. I need a cost of living adjustment to keep up with that. So I think basically what we're seeing is kind of the last leg of that wage surge in response to high inflation and tight labor market. But of course, both of those pressures have diminished substantially. The labor market is much less tight than it was at the beginning of 2022. And headline inflation and near-term inflation expectations are much lower. So I think it's fairly clear that the things that drove high wage growth are on the way out, not on the way up. It takes a while for wage growth and inflation to come back down, because not every price or every wage contract changes the very next month. And I think that's basically all we're seeing with the union wage increases.